month ago. Huge thanks to Rohan Singh, my colleague. Together, we are running these weekly YouTube sessions. Just want to start off with our YouTube site. It's called Charts Are Fun. That's the channel at Charts Are Fun. Our goal here really is to educate you about how to use charts for your investment decisions. We are not providing any kind of investment advice because we're not professional investment advisors. Our goal here really is to guide you on your decisions using charts as a guiding tool. We have been creating shorts. So while we have 30 to 45 minutes of weekly recordings, short 1-minute clips have been put out as shorts. As you notice, here are some of the shorts that identify different technical patterns. Today, I'll be covering a very interesting pattern called Symmetric Triangle on a very exciting stock that's been in the news a lot, on Tesla. But overall, this is one part of our service where we do weekly sessions and then we put it out on YouTube. The second thing that we also do is we have been doing our regular blogs, and these are daily blogs. So if you go to the archive, the blog site is in Substack, so chartsarefun.substack.com. You can also access the blogs directly from our website, chartsarefun.com. So going to that blog site, if you click on archive, you'll notice that we have all the various daily blogs that are listed. Over the week, a lot of exciting things have happened. There was this blog about Tesla coiling up for a breakout. I'll explain that shortly in terms of the symmetric triangle that it formed. We talked a little bit about the crypto market. It's also been on quite a climb since February. Initially, after the ETFs were launched, we got a bit of a pullback, but then it took off, and there's been a lot of excitement on cryptos. CPI data came out, and that raised some interesting discussions. This was CPI data that showed, again, and I'll talk a little more about it. There was a nice blog on Bull Street on it, where services inflation, core services inflation has actually been going up again, a bit of a concern. And while folks thought that the month in January was an exception, February showed a trend, and looking at moving averages, in particular 6-month moving averages, you can notice that CPI has been trending higher. That did raise concerns about the Treasuries. So we did see flight to safety, not so much of flight to safety, because flight to safety brings yields down from the other way around. We saw some fears of Fed being not as dovish as people were originally thinking, and that actually brought interest rates higher. The 10-year yield in particular went up this week. And then very recently, I published a couple of exciting blogs, one on the Indian stock market that has been doing extremely well, and I'll talk more about that. That'll be the last section of today's video. I'll talk quite a bit about what happened to the Indian stock market and which sectors did very well. And then a blog that I posted today, which I'm going to cover after the market overview, on the NASDAQ 100 ETF QQQ. An interesting similarity of that, while I did talk about the fact that there's a very interesting blog that was written by, the famous hedge fund founder, as well as famous economist, Ray Dalio. He actually has a market gauge predictor on bubbles. And in fact, if you click on the blog, you can get to see this market gauge chart. And as you can see, in the late 1920s, before the Great Depression, we had a huge bubble in the market. This was after World War I. The market hugely shot up. And then we got the Great Depression, the big collapse in the market. In a similar way, this is the dot-com bubble that we notice how, and this is basically something that he calculates his proprietary gauge indicator. And he's been showing that the closest to the bubble that we got recently was in 2021, after the dot-com, not the dot-com, after the COVID liquidity that came in the market. But now we are nowhere close to, and the horizontal line is at 70% and higher. We are nowhere close to it. Right now we are at 52%. So he's got, his opinion is, valuation-wise, and from a bubble gauge, we still got ways to go before we officially call it a bubble. So that said, he feels that there is upside in the market. But interesting enough, in terms of just technical patterns of how QQQ, which is the NASDAQ 100, went up from October 99 to March of 2000, and similar ways of October 2023 to March of 2024. I'll show some interesting patterns where there seems similarity. There was the dot-com euphoria at that time where Cisco was the leader. And in the recent market, the euphoria, as you all know, is AI, NVIDIA being the leader. Not as such comparing NVIDIA to Cisco stock as much as looking at QQQ as the NASDAQ 100, where both of these were like market weighted. So both of these were big portions of that index. Back in 2000, it was Cisco. Now it is NVIDIA. And just to show you what happens, talking about NVIDIA, they do have their GTC, which is their annual conference, expectations of some new product announcements, especially their famous GPUs, the A100s, is now going to be followed up with their B series of GPUs. So there's going to be interesting news about the high bandwidth memory, the HBM part of it, how it's overall going to play out in terms of price productivity and performance of workloads, AI workloads on the chip. It's the Blackwell. B stands for Blackwell, but it's the Blackwell series of chips that Jensen Huang is planning to launch on the 5. I think it's 5 Eastern on Monday is when the launch will be. So coming back now to what exactly happened in the market. Let me just go full screen here again. So we noticed that starting off with equities, there was red across the board. So the Dow, S&P, NASDAQ, they all were down. In particular, NASDAQ got hit the most. It was down almost 1%, minus 0.96. S&P 500 at minus 0.65, and then the Dow was about less than 0.5%. The NASDAQ 100 actually fell more than the broader NASDAQ. It fell 1.15%. And notice the small caps was the only one that actually was outperforming today. It was up 0.5%. So among all of the indices, the small and the mid, small cap was the one that actually did well, and rest of it were all mostly red. Looking at the bonds today, the 30-year yield actually slightly went lower, but across the board, 10-year, 5 years, all actually went up, which increasing the fears of Fed being hawkish next week. And that's the FOMC meeting next week. So there is Tuesday and Wednesday is typically when the Fed meets. And next Tuesday, they start meeting, and then the press release and the press conference happens after 2 o'clock is when they release their the projections and what the expectations are from the FOMC, and then at 2:30, Chief Powell goes on the press conference. So next Wednesday is going to be an interesting market moving event, and of course, NVIDIA GTC with the Jensen's post-market close at 5 o'clock. His keynote will also be a market moving event next week. And commodities this week actually had a very interesting situation where this week actually oil did very well, though today it was only a 0.04%, but copper was the really poster child of this week. There was worries about supply constraints, and then just the fact that copper is a leading indicator of the market economy. There is feeling that there will be demand in the economy worldwide, and that kind of led the copper prices higher. So it was almost up 2% is what we see as a commodity. Silver did well. Gold actually took a breather, and we can see that natural gas was actually down quite a bit. As we know, it's been a seasonably warm winter, and that's affected natural gas prices quite a bit. Crypto, on the other hand, was up across the board. Bitcoin in particular eked out again, though during the day it had fallen closer to 60, as you can see here, it was almost closer to 66,000, dipped right below 66, but kind of reclaimed some of the losses of the day and closed near 70,000. So Bitcoin, as you know, has been very volatile, but there seems to be still quite a pent-up demand on cryptos in general. Ethereum was kind of flat, 0.09, XRP did better, and Bitcoin Cash also was up 0.8%. So looking back from the overall market now into what happened in the key 11 sectors last week. So let's look at the next chart. And actually, before I do that, let me highlight something very interesting. If you look at market movers for the S&P 500, one of the top market movers today was Tesla, and it has been a lot in the news. Tesla, as we know, has kind of downgraded their sales projections for this quarter, upcoming quarter. Typically, seasonally, they do better in the first quarter than the fourth quarter of the previous year. But this time, they kind of projected a flat sales. We know that there was recent sales data from China for January, which was not very strong. And overall, there's just been a lot of concerns in Tesla as a stock and slowing down in their EV sales. Turns out that today Tesla was up 0.61%, and it was one of the active stocks. So looking at Tesla from a perspective of a longer term view, so this is actually the monthly chart of Tesla. And what we are talking about here is a very interesting pattern called a symmetric triangle. The symmetrical triangle in here, the way you draw it is you take the peaks of the stock, in this case, the candles, and you draw a line across it, and then you take the lows and you draw the line across it. Notice how the line across the peaks that's declining and the lines across the lows that is climbing are coming to a point to almost an apex. The idea of the symmetric triangle is when this happens, the usual break is in direction of the primary trend, which we know in Tesla's case, the primary trend has been an explosive growth higher. A pullback came, but the expectation is that this could potentially be a breakout on the upside. Now, if you look at the bottom of the trend line, it's right near 145. So that's kind of where the symmetric triangle is panning out. The expectation of the stock is to reach 145 and then have a massive explosive upside breakout. Now, talking about fundamental reasons of where Tesla could be headed, they've been reading stuff saying that they are projecting $3 of earnings per share for this year, which is 2024, and taking a P by E ratio of 40, which people are saying is still, knowing that Tesla's growth is slowing down, is still being very conservative with their P by E ratio, knowing that NVIDIA's P by E ratio is below 40. So giving it a P by E ratio of 40 at $3 of earnings per share, that gets you at a $120 target. So I've been reading folks. In fact, there was an article by, in fact, not an article, but an analyst rating from Wells Fargo this week, downgrading Tesla to a target near 125. So that kind of gives you a feeling where that 120 number is coming from. However, next year's earnings is expected to go from $3 to $4. So if it goes to 4 and you give the same multiple of 40, that gets you to 160. Now, as you know, the very bearish scenario being about 120, the kind of semi-bullish being towards 160. If you take the midpoint around 140, fundamentally a move towards 140 also nicely gels with a higher low. So if you notice from early like the COVID low, it was in 23, the pullback that we got towards the bear market bottom in 2022, October to November, it came closer to 102. In fact, December of 2022 was very bearish, not just in Tesla, a lot of the Magnificent Seven stocks, Facebook, as in Meta, Google, they all were actually had seen aggressive pullbacks. Even NVIDIA had an aggressive pullback around late 2022. That was when the tech sector bear market was kind of bottoming out. So from there, it went to a lower high. So 414 was the absolute parabolic move in Tesla after the COVID low, and that was when the 2021 euphoric high happened. And then since then, it's been printing lower highs to the point that the highs for 2023 was near 300, 299. It wasn't able to cross 300. So now, if this triangle pull back towards the lower ascending trend line towards 145 happens, it also fills out a gap. There was a gap from January of 2023 when Tesla actually gapped up higher after good earnings from the 145, 146 level and never came back to that. The lowest it has come back is 152. So far today's, this week's low was 160. Potentially we could get to 146, close out that gap, which is what typically happens. And then Tesla could be actually a great long-term buy. If this symmetric triangle pans out, we're talking about a breakout, likely taking out the previous highs and going, if you look at Kathy Wood's projection on Tesla, she's got a 2000 price target. And again, she expects that Tesla's dominance on the EV space will be strong. By 2030 and higher, there's going to be a significant market share that it will have. Its innovation around the EV space. And remember, there were some analysts talking about Tesla not just valuing it for its EV, They have some very, very cool things with respect to their autonomous driving. In the autonomous driving, they are monetizing currently at $200 a month for that feature. If they get and improve that, that itself is a SaaS service that can improve. Also, they plan to launch a cyber, like almost a autonomous taxi service, where their software will be used across the board as a SaaS service, much higher margins that can also, like if you talk about EV margins, it's around 30%. That's the best case. These days it is being below 20 because they've been cutting price a lot. But SaaS margin could be north of 80%. So that's going to improve the margin on Tesla and potentially could take the stock much, much higher. So if you believe in the founder and the innovator Elon Musk and in what his dream is with the company, there is potentially a lot of upside. And this could be an absolutely great buy point if it does pull back to fill that gap near 146. So I'm looking at a target near 145, 144 as an entry point, as a long-term entry point. Now, going in next to what happened to the industry sectors. So we talked about the 11 sectors, and this week, unlike last week, this week utilities actually took a drop. Last week, utilities was among one of the top ones. This week, energy has done very well, up 3%, and the ETF for energy is XLE. Materials was also very strong, up 1.6% for the week. And we know what happened in materials. It was copper that did extremely well this week, and so did aluminum. Overall, just a set of non-ferrous metals actually did very well this week. And so energy did well because of oil prices going higher. Oil prices went higher because the International Energy Agency, IEA, projected growth in terms of oil demand this year that helped the markets. And then there was a drone attack from Ukraine onto Russia. Rosneft, one of their key energy companies in Russia, one of their refineries were taken down by the drone attack. That caused oil prices to go higher up as well. So those two sectors did very well this week. Overall, as you can see otherwise, and then the consumer staples, which tends to be the defensive sectors, when the market overall is looking ready for a correction, the defensives start working up and they do well. And the financials did well because the expectation that maybe interest rates will go higher. Higher interest rates do improve the net interest margins and does help the banks and the financial sector. That did reasonably well at about 0.42% this week. And at the bottom of the sector, which happened last week and this week again, are really discretionary, which is in some ways, it's like the needs versus the wants. Staples are needs, things that you need to, for your day-to-day living. Versus want is what, ideally, if you had extra money, is what you would want to have. So discretionary is actually where Tesla falls under. Discretionary is where Amazon and other, stocks fall under. So discretionary was actually one of the poor performing stocks. But the worst performing was actually real estate sector fund, which actually is very, very sensitive to interest rates. If interest rates are going to go higher, and if there's fears of mortgage rates going higher, it does impact the real estate market. So real estate actually took a hit, was the worst performing sector this week, down almost 3%, 2.8%. Technology sector, as we know, was yet again a weak performing. And some of the key stocks like an SMCI, like an NVIDIA and others did pull back this week. And QQQ also pulled back week over week. That kind of caused the technology sector to do not as well. So now going to a little bit of the deep dive on the industrial components of the sector. So the communication services, you can notice that's where the internet stocks are. Internet stocks actually did reasonably well. It was up 0.28, but the remaining media agencies got hit quite a bit at down 2.8%. That's where Disney and others fall under. Publishing also got hit 1.8 and so on. Consumer discretionary was pretty poor across the board. This is where most of the retailers fall under. And you can notice that there was active selling. Furnishings, for example, was down 4%. That's one of the worst performing. And automobiles were down 5%. So, Tesla's there, but the big automobiles from the US, Stellantis, General Motors, Ford, all of those are part of the automobile industry. And that was down almost 5% this week. So now, if you look back down to consumer staples, that was a better performing. Brewers did very well. There must have been some good brewers earnings. There was up 3.4%. Tobacco did also very well, 2.76, and distillers, miners did also well at 2.87. Energy, as we said, across the board was a strong sector this week, and Oil equipment services was up over 5%, integrated oil 3%, exploration production over 4%. So this was a sector that benefited from higher oil prices. And you can see when you have a price that goes from left, bottom left to top right, that indicates a strong trending. And this was over the full week. And in this case, you're looking at the oil equipment and services. This is a classic bullish looking chart. When from bottom left to the top right, it moved up throughout the week. Financials, as you know, overall did okay. It was about 0.4% up. Things that didn't do so well was banks at minus 0.46, but things that did do well was insurance. There might have been some insurance earnings. Property casualty insurance was the best, 2.37%, and mortgage finance in this case was up 4.25%. This could have been related to some of the commercial mortgage companies that might have had earnings this week. Healthcare was not as great, other than healthcare providers, which are the hospitals and some medical supplies, barely up 0.16. If you look at medical equipment, biotechs, and the pharmaceuticals, they all took a breather. So as we know, pharmaceuticals and biotechs have been doing well recently, but they all took a breather this week. Industrials also overall didn't do as well. We can see that airlines took a big hit, down almost 4%. Aerospace also took a hit of almost minus 1.7%. And the others were kind of, the only thing that did well in the industrial sector was actually the commercial vehicles and trucking sector, up 2.2%. And then the diversified industrials did reasonably well at 1.4%. Materials, as we talked about, the key beneficiary was the non-ferrous metals. That's where copper lies. It had a great week. Aluminum was also up 2%, and the rest, specialty chemicals, commodity chemicals, were up a little more than 1%. Real estate, as we said, across the board did not do so well. Got hit because of fears of interest rates going higher, mortgage rates being hit. And technology, as you notice, had a pullback. In particular, semiconductors had a bad week, down almost more than 2%, 2.2%. And so did computer services, down almost 1.85%. The only two sectors that stood out in technology were computer hardware. We actually got a little bit of upside in Apple, finally a little bit of a snapback after dropping below 170 last week. It closed above 170 this week. It closed above 172. So a little bit of upside on Apple helped. And then on software, we know we had very strong earnings from Oracle. So Oracle did absolutely great this week. And that, along with a few other software stocks, helped the technology sector. And then utilities actually took a breather. Utilities tend to be correlated to interest rates. When interest rates start having fears of going higher, utilities do get impacted, and they had a bad week. So now I wanted to bring back the key article about what happened with the CPI. This, after it came out, there was an interesting blog posted in Wall Street, and this blog talked on the fact that if you really look at the core portions of CPI, the core CPI, we take food and energy, volatile components out. The two core portions are 61% is actually services, and we know US is a heavily services-based economy. And then the durable goods, the actual goods and products that are sold, that part of the inflation is the remaining 40%. So that's where the cars and any other sets of items that we buy are accounted for. But in that 60% part, where the core inflation, the core services inflation falls under, that's further broken down into some part of it that's related to inflation, as you can notice in here, things that are very, very sensitive to housing sector and things that are not. See, I think that 61 is broken up into roughly 61.762 is 36, and I think it's 38 and 20, 36 and 26 are the two components. But in there, the key parts are that if you take at the inflation data, and if you take the rent part out, because rent, they said that, oh, that's a temporary thing, it'll resolve. But interesting enough, this is the core services, taking the X housing is taking the housing out. And this is where other components of the services comes in, such as healthcare costs comes in here. Things that are also showing, and if you look at the curve in red, that's a 6-month moving average. And if you look at the 6-month moving average from close to 2%, It's trending towards the 6% steadily since the bottom in like middle of 2023. So that's something not to be ignored. This fact that services is 60% of the CPI, and the fact that a core component of that, the services without the housing, has been trending higher, that's a concern. That's something that you will bet Federal Reserve will be concerned about. So that initial expectation of 3 rate cuts, which after the CPI came down to 2 rate cuts for the year, we'll have an interesting debate after Chair Powell announces his statements this week. So after Wednesday, the market will be intently watching what does he say about the cuts, what does he say about his expectations for inflation moving forward. And any sense of hawkishness will not be treated well in the market. So now how do we manifest that into a very interesting chart which reads the inflationary fears best is the Treasury market. So in here, we're looking at the chart of a 10-year Treasury. And in here, what we notice is there is a key resistance level, which you see in the dashed line at 4.36. But if you look at a trending channel, and by joining the peaks and joining the lows, the trending channel since the low in December, late December 2023, was around 3.78%. This is when back in mid-October, there was huge fear because Fed kept talking about higher for longer. There was huge fears of inflation, and we had 10-year yield hit as very close to 5%. It hit 49.97, which is 4.99. In fact, after hours, it actually even crossed 5% for a couple of days at that time. So from that close to 5%, it came down to 3.78. So that's a 120 basis points drop in 10-year yield, or 1.2%. Now, from there, the month of January into February, we know that CPI data for the January was hot, published in February. And then from there, the one that we got for February and March has also been reasonably hot. So this movement that you see when it touched the bottom of the trend line, and then the last 5 days, 1, 2, 3, 4, 5 days, it has been going up, is after that CPI data. And effectively, the market is expecting that maybe interest rates could be a concern moving forward. And market is hence very jittery about potentially a hawkish FOMC or a hawkish Powell next week. Now, one pattern here that needs to be monitored is, of course, it can go up to the top of the ascending channel and can go test maybe 4.4, 4.5. But if you look at a cup and handle here from 4.3 down to 3.78, back to 4.35, and then a breakout, that measurement from 3.8 to 4.35, that you're talking about roughly 0.55, add to 4.35, that's back to 4.9. So we could potentially have a shoot up in 10-year yield, and that will not be market friendly. An expectation of 10-year yield shooting at past the key resistance at 4.35 back towards the 4.9 will actually be very negative for the market. Similar trend that maps out strongly correlated to the Treasury yield is the dollar. So this is a dollar ETF called UUP, and you look at a beautiful cup and handle pattern. It's yet to be panned out until we get the break above the top of the cup. It's not yet a cup and handle, but potentially we are thinking that this could look like a cup and handle, with a cup in this case from 28.35 down to the bottom of the cup near 26.9, coming back to 28.2, and then a shallow handle forming. If this breakout pans out, so next week after Powell, if he's hawkish, if 10-year yield breaks past 4.3%, you can expect the dollar to rally. You can expect, because the dollar means that if the US interest rates are higher, there's money flowing in, money parked from outside countries into US because of the higher interest rate that it pays. It's going to be bullish for the dollar, and the dollar will break out. If the dollar does break out, the measured target on this cup and handle, by the way, is a lot higher, near 29.6. Currently, it closed near just below 28, 27.98. So that's something for us to watch for the next few weeks, especially next week, to see how the dollar. And that's, again, dollar tends to be safe haven buying, money moving out of the stocks and bonds, sometimes indicates money moving into currencies as a safe haven buying. And by the way, dollar moving higher will also be bad for the commodities. Gold, you can expect, will have a pullback. So will commodities in general, because they tend to be negatively correlated to the US dollar. Now,